Csquare is a massive North American data center platform going public to raise over $1.1 billion.
They have an incredibly sticky business model, selling enterprise collocation and interconnection services.
Well, that's some high-tech jargon, but it's pretty simple when you break it down. Bear figured it out.
Collocation simply means these data centers aren't built for a single AI giant. Multiple businesses utilize the facilities.
Each business can have their own secure space within the data center, but the co-location aspect allows for efficient interconnection services.
That's right. Multiple companies can connect servers to streamline data streams.
Your bank and brokerage may want to be in the same data center.
Or online gaming and esports platforms.
Or the hospitals, medical imaging companies, and insurance companies.
Once your systems are set up and connections made, it become very difficult to unwind and replace those infrastructures.
The revenue is super predictable. Contracts average 33 months and customer churn is literally under 2%.
So they aren't just renting out empty rooms. They're providing the high-voltage engine rooms, handling massive power density, and utilizing liquid cooling systems absolutely crucial for the high-tech.
So how big are they?
They operate 64 data centers that generated nearly $987 million in 2025.
Their operating income topped $100 million in 2025.
But then, bam, $120 million net loss.
The $240 million in interest expense and roughly $270 million in depreciation just killed them.
So part of the proceeds from the IPO is targeted to pay down debt.
Hopefully that gets some of that interest expense in check.
And if there are any real estate professionals out there, we know that depreciation often acts as a paper loss.
We would need to identify their maintenance capex to be sure on that. But let's play the real estate depreciation game as if it were a non-cash paper loss.
So in commercial real estate, two of the ways to look at broad value are cap rate and price per square foot.
For each of those, we need the total offering price.
In this case, that would include the total shares plus the debt minus the cash on hand.
If we use the midpoint price of $25 per share and run the math on the rest of it, we come to a total value of $7.96 billion.
That price per square foot is bonkers from a value investor perspective, but we have to remember this isn't a pure real estate play.
This company has high-margin services that are added into the operations.
Connecting the wires pays big.
So how do we look on a cap rate basis?
Again, this operation consists of more than just renting real estate. Sorting out the corporate structure line items to arrive at the traditional operating income that real estate investors look at is a little tricky.
Well, we can get close. Just for fun, let's see what we get.
Okay? If we start with the most recent full-year GAAP operating income and add back things like depreciation and other corporate expenses that wouldn't typically be included in a down and dirty cap rate valuation, we get a little over $475 million.
And if we divide that number into our total value, we get a cap rate of 6%.
That actually sounds more in line from a valuation perspective.
It does. But given the nature of the business, an astute investor is going to look beyond these broad-based valuation measures.
Cap rate valuation is meant to be more of a snapshot anyway.
We have a sticky business here with loads of real estate, backing up the overall business model.
Stay tuned and check back to see how this evolves.
Don't forget to like and subscribe.